Thanks, Kirsten, and thanks everyone for joining us. On today's call, I'll provide an update on the business and then turn the call over to Izzy to review the financial results and guidance in more detail. Starting with a few key messages. Our third quarter adjusted EBITDA of $106 million was in line with our expectations despite revenues of $354 million coming in below our expectations for the quarter, primarily reflecting softer than expected results from digital wallets. We continue to see strong momentum across our strategic priorities that we set out at the time of going public as we grow with some of the true leading-edge companies in faster-growing segments of the market. In North America iGaming, we announced several customer wins in the third quarter across multiple states and really like our position as new states and online players come online. Additionally, the Skrill wallet, while still small in the U.S., continues to show good progress. Outside of iGaming, we continue to position ourselves as a disruptive, specialized payments platform with our combination of cards processing, eCash, wallet pay-in and pay-out, and real-time banking solutions. In particular, our pipeline across crypto, digital wallets, and financial services continues to build. The U.S. acquiring business continues to perform well with solid growth, and our direct marketing vertical now shows strong signs of recovery. Lastly, we are on track to meet or beat all of our cost takeout and tech platform milestones. At the same time, we are facing challenges within the digital wallet business, which has performed below our expectations. We've identified the cause of the headwinds, both internal and external, and we're taking action to improve the core wallet and to pursue the real growth opportunities in front of us. However, with the headwinds we're seeing in our markets, coupled with a low exit rate in 2021, we believe it's going to take another year to reset the digital wallet business and get us back on a path to growth. As a result, we are lowering full-year guidance for 2021. In that context, we're also providing a preliminary update on 2022. While this is disappointing, we have a strong growth plan, exceptional talent under new divisional leaders in wallets, and the right core assets in place to reposition digital wallets for success. And when we combine wallet capabilities with our e-commerce and eCash solutions, we are winning the deals with the leading players in fast-growing markets. Turning to slide 4 of the presentation. While Izzy will provide more detail on financial results and guidance, I want to share some context on what we're seeing today compared to what we discussed on our last earnings call. When we reaffirmed the outlook back in August, we'd expected a return to double-digit growth and strong margin performance in the fourth quarter. At that time, our confidence was supported by 4 main drivers. First was our expectation that the direct marketing headwind would start to improve in the second half. This is recovering as expected, with revenue up sequentially and continued strong growth of new merchants in the third quarter and early fourth quarter. Next, we expect a continued execution on cost savings. We've delivered $26 million year to date and expect to deliver $35 million in 2021, 17% higher than our original target. Third, we had signed agreements in place on large deals in our e-commerce pipeline. These are still in progress. However, the scope and timing will differ from our initial agreements, meaning volumes will be more spread out versus the ramp we initially expected in the fourth quarter. Finally, we had an expectation that digital wallets would see a soft third quarter followed by improvements in Q4. As I mentioned, the performance of digital wallets has been lower than expected in the second half of the third quarter, and we see this continuing into the fourth quarter driven by market softness and performance challenges that are being addressed. Turning to digital wallets on slide 5. I'll start by unpacking the headwinds here and specifically our current expectations relative to what we last discussed. Earlier in the year, we saw the fundamentals improving with a stronger, firm baseline following our exit of network referral accounts and solid indications that we were lapping these headwinds as we approach the second half of the year. Turning to the summer, we are seeing quiet European activity coinciding with the removal of most lockdown restrictions. This softness, coupled with our expectations for a return to normal seasonality, informed our outlook for Q3 as communicated on previous calls. At that time, we expected improvement in Q4 driven by seasonal growth as well as uplift from prior marketing incentive programs. However, what we are seeing is continued market softness, particularly due to the regulatory environment in Europe. Overall, the third quarter came in below our expectations for wallets, and we see this extending into the fourth quarter. As an example, in Germany, the adoption of new regulations had a more meaningful impact than we anticipated, with several operators reducing activity or leaving the market. Additionally, in the Netherlands, we're seeing a medium-term impact related to local licensing requirements. To put some numbers around this, we characterize the impacts of our headwinds in 2021 as the following. First is the network impact, which is north of 20 million. We are lapping this at the end of the year. We expect this to be partially offset by growth in the core business, as discussed on prior calls. However, since then, our expectations have changed. First is the softness in the European market, including the regulatory impacts, which has dampened the uplift we'd anticipated in the back half of Q3 and in Q4. These factors, combined with the impact of some counterproductive customer pricing and tiering, have brought us to a lower base of the business as we sit here today. We are actively driving changes to strengthen our core proposition, particularly in more mature markets. As you recall, we transitioned to new leadership within our digital wallets business in Q3, bringing on Chirag Patel, who brings extensive global payments experience to Paysafe. Together, we are moving quickly to reset the business and respond to the real growth opportunities in front of us. Let's now go to the next level of detail on slide 6. First, what are the challenges? One, we have the legacy issue of network accounts, and we are lapping those items. 2, the core wallet has to be more competitive in terms of customer user experience and in terms of pricing in more mature markets. Third, the digital wallets become too complex over time. We have to simplify the product offering, right-size the organization, and clean up the balance sheet. Lastly, we have to deliver on the bigger initiatives in front of us. Moving to the right-hand side of the page, you'll see we're taking immediate short-term and mid-term steps to address these challenges. First, we're taking actions to address customer experience and pricing to be more in line with the market. As an example, we are overpriced in certain deposit forms, which has had some counterproductive outcomes. Equally, we are underpriced in other parts of the wallet where we see opportunity. We have tangible actions underway and are already seeing some positive results. Additionally, we will be streamlining the organization, including rationalizing subscale product features. And finally, we are taking on actions to right-size the division as we focus on the core wallet. Turning to the midterm, we have several programs underway, and these absolutely underscore why I continue to see digital wallets as a true differentiator with the opportunity to partner with some of the most disruptive players in the market. We have an active program underway to strengthen our relationships with our top merchants. We've reset and increased our engagement with all our top clients and are having very constructive discussions around their pain points, ways to collaborate, and ways to drive better conversion and growth. We're already seeing positive developments here, recently opening several new markets with one of our largest and oldest clients. In North America iGaming, we will continue to grow and deliver on our enhancements to the Skrill digital wallet, where the numbers are small today, but we're really pleased with the early progress, including our expansion to 11 brands, strong conversion rates, higher than market average deposit size, and great proof points with some up-and-coming operators. We are now capturing double-digit share of their cashier. Lastly, we will continue to invest in expanding our crypto presence, where we are not only expanding in terms of our ability to trade more cryptocurrencies within the wallet, but are also seeing very tangible interest from some of the top crypto platforms due to our unique combination of card processing, real-time banking capabilities, and wallet pay-in and pay-out capabilities. Although these initiatives all drive real value next year, we expect 22 to be a transitional year for digital wallet, followed by strong growth as we reset the division and deliver on initiatives. To summarize, while we have challenges to address, we have a strong plan, exceptional talent, and the right core assets in place to reset the business and unlock value that exists within our digital wallets. We're a leading provider of a highly functional digital wallet to a large active customer base of gamers and traders. Additionally, our pay-in and pay-out functionality across the globe continues to create excitement with some large disruptive players. That combination of capabilities continues to drive my personal excitement for our digital wallets as the most unique and highest value asset within Paysafe. Turning to slide 7, I'll now quickly touch on direct marketing. As we discussed in our last two earnings calls, we exited a discrete set of clients and referral channels as we entered 2021, based on our views of the market and our anticipation of compliance changes. So we've been in a transition period this year as the market adjusted to these new rules. The recovery is well underway and in line with our expectations. In June, net new merchants turned positive, and we saw this progress continuing into the third quarter. Additionally, we expect a strong fourth quarter with net new merchants for the month of October already exceeding the levels from the entire third quarter. Overall, we're on track for direct marketing vertical to return to growth. I'll now move on to slide 8. When we look at the rest of our business across eCash and integrated processing, representing 70% of our revenues, we see continued strong momentum with high teens growth this year, as well as strong trends relative to pre-pandemic levels. Looking ahead, we expect continued normalization of the growth rates in eCash, as well as continued double-digit growth in integrated processing. Now let me dive deeper into some of our strategic pillars. Turn to slide 9, starting with North America iGaming. We've grown revenues 50% year-to-date in North America, reflecting strong momentum as the market continues to open up. Within this growth, we're expanding relationships with new and existing operators who trust Paysafe to provide customers with all the ways they want to pay. We are now live in 19 of the 21 legal jurisdictions across the U.S., having recently launched in Arizona, Wyoming, Connecticut, as well as Louisiana, which is live for deposits ahead of a full launch expected in early 2022. We're also looking forward to upcoming launches in Maryland, Florida, and New York. We're seeing multiple operators sign up for the full suite of our payment options, with several more Tier 1 operators on the way. Turning to Canada, we're building on 10 years of market leadership as the exclusive payments provider for regulated online gaming traffic. We are well positioned to be the dominant player as the Canadian market opens up to private operators, specifically in Ontario, where we have signed multiple deals with Tier 1 operators that we expect will be the leaders in that market. It's a real testament to our deep industry relationships, our superior offering, including an acceptance rate of more than 90% and multiple acquiring options. Lastly, as mentioned earlier, we continue to advance our Skrill wallet revamp and add new brands to our pilot in the U.S. As I mentioned earlier, the volumes are small today. We're pleased with the early results with 11 brands, strong conversion rates, higher average deposits, and achieving double-digit share with some of our earlier operators. Overall, I'm really pleased with our progress. We have a number of key announcements on the horizon, and we're really happy to have Zach Cutler on board, leading this highly focused team dedicated to winning in North America iGaming. Turn to our other key digital commerce verticals. In eCash, we continue to see a lot of traction and exciting use cases across financial services. We are further expanding our network supporting financial inclusion, enabling cash consumers to pay bills at more than 4,600 Walmart stores across the U.S. in partnership with Incom. Building on some of our prior announcements, our eCash business now partners with the largest neobanks in Europe, including Moniz, Bunk, and N26. In crypto, we continue to add cryptocurrencies available to trade in digital wallets, and we're seeing very compelling pipeline opportunities with crypto operators interested in our global risk management and pay-in and payout capabilities. Lastly, with our partnership with Visa, we've launched Visa Direct, further enhancing more payment options. Now turning to slide 10, we are on track to meet or beat all of our cost takeout and tech platform milestones, which will set us up to go to 2022 with a more efficient cost position. We've been focused on migrating the business to cloud, and we've already achieved our target for 21, with 70% of our business across Paysafe now on our new tech stack from effectively 0% 2 years ago. We've also made strong progress in our cost savings program, taking out $26 million year to date. We expect to deliver $35 million for the full year ahead of our initial target. On our recent acquisitions, we're well on track with integrations, and we're enthusiastic about the interest we're seeing from both existing and prospective new clients, particularly across iGaming and crypto. While it's early days, we already have several cross-sell initiatives underway. Before I hand the call over to Izzy, I'll reiterate a few points. Our strategy remains intact. We continue to see the unique combination of payment solutions as a real differentiator, particularly in more demanding markets and with more disruptive clients, where alternate payment methods and risk management have a true premium. We're winning deals in North America, We really like our pipeline and growth opportunities in emerging verticals like crypto. We're delivering against our cost and tech milestones, and we're very happy with the initial progress on our recent deals. However, there is work to do in digital wallets, but the combination of our capabilities position us well to win in the right markets with the right players. With that, I'll turn the call over to Izzy.
Thank you, Philip. Let's turn to slide 12 for a quick summary of our performance versus our guidance. Revenue and gross profit came in lower than our expectations due to market softness and challenges in digital wallet segment, as Philip described earlier, and integrated processing, which was also lower than our expectations, reflecting lower activity in our ISO channel. On a positive note, expenses were better than expected, including strong performance and cost savings, and adjusted EBITDA was in line with our guidance range. Turn to slide 13. Volume for the third quarter was $31.1 billion, up 19% year over year, with growth in integrated processing and eCash, partially offset by decline in digital wallet. Total revenue for the third quarter was $354 million, down 1% year over year, with take rate compression reflecting business mix. Excluding the impact of the Pay Later business, which was divested in October of 2020, revenue would have increased approximately 2%. Adjusted EBITDA for the quarter was $106.4 million, down 1% versus the prior year, resulting in adjusted EBITDA margin of approximately 30%, consistent with the prior year. Excluding the impact of Pay Later, adjusted EBITDA would have been flat to last year. Lastly, free cash flow was $70 million, or 66% conversion on an adjusted EBITDA basis. Year to date, our free cash flow conversion is approximately 70%, and we currently expect free cash flow conversion for the full year to end up around 70% as well. On slide 14, we're provided the same supplemental view as we did last quarter. Demonstrate growth excluding the divestiture of Pay Later and the direct marketing vertical. With these adjustments, year-to-date revenue for the rest of Paysafe's business grew 13%, and adjusted EBITDA grew 16%. We provided the same view on the integrated processing segment in the appendix as well. On slide 15, I'll touch on a few additional line items, including our GAAP results. Interest expense was $19 million for the quarter, and we expect interest expense to increase in Q4 to approximately $27 million as a result of the completion of our debt raise in early October. For Q3, our net loss was $147.2 million, which included an impairment charge of $322 million relating to intangible assets within our digital wallets business. This was partially offset by a fair value gain, $94 million, resulting from the remeasurement of warrant liability at quarter end. Our effective tax rate with an income tax benefit for the third quarter was 34.3% compared to 27% in the third quarter of last year, due to the tax impact of the impairment charge recognized in the quarter, as well as the impact of deferred tax balances of the increase in the UK statutory rate. Moving to segment results on slide 16, starting with eCash. Volume of $1.3 billion and revenue of $90.2 million both increased 10% compared to the prior year, as we see continued strength in the business as we enter a post-COVID environment. Excluding Germany and Netherlands, which have been impacted by recent regulatory changes, revenue growth was greater than 20%. During COVID, many merchants in specialized e-commerce verticals enhanced their cash capabilities. Compared to Q3 2019, our current revenue run rate is approximately 26% higher on a constant currency basis. Adjusted EBITDA was $36.3 million, an increase of 18%, resulting in adjusted EBITDA margin of 40.3%, an increase of 270 basis points year over year. Moving next to digital wallet on slide 17. Volume for the third quarter was $4 billion, down 17% year over year. Revenue in the digital wallet segment for the third quarter was $83.7 million, a decrease of 15% compared to the prior year. Take rates remained elevated compared to historical levels, yet stable. The year-over-year decline, which is worse than expected, reflects a combination of regulatory impacts in Europe and performance challenges that we are addressing, including the unfavorable impact from pricing and tiering initiatives from late Q2 2021. Adjusted EBITDA was $39.9 million compared to $48.1 million in the prior year. Now moving to slide 18. Integrated processing volume of $26 billion was strong, up 28% led by the U.S. market and up 39% versus Q3 2019. Revenue for the third quarter was $186.9 million, an increase of 4% compared to the prior year. Excluding the Pay Later divestiture, revenue increased 8% with growth from our U.S. acquiring and e-commerce merchants partially offset by lower revenue from our direct marketing channel. Take rate was roughly 70 basis points, down from Q3 2020, but flat sequentially, which we discussed on our prior call. Adjusted EBITDA was $44.4 million compared to $48.7 million the prior year. Adjusted EBITDA margin of 23.8% decreased year-on-year due to merchant and channel mix, in addition to the decline in our direct marketing channel. Excluding the impact of Pay Later and direct marketing, revenue grew 16%, adjusted EBITDA 19%, reflecting margin expansion. Our North America iGaming activities, which is predominantly driven by the integrated processing segment today, grew more than 30% year over year and is up approximately 50% year to date. North America iGaming is roughly 1.5% of total company revenue year to date. Moving next to slide 19, I will review the components of our consolidated take rate, which continue to be driven by business mix and have been consistent over time within our business segments. eCash continues to generate a take rate over 7% in line with long-term expectations. Digital Wallets has increased its take rate over time as we build out functionality and access to new markets such as FX trading and crypto trading. We anticipate long-term take rates to be around 1.8%. Finally, the take rate in our processing segment has decreased for the last few quarters to roughly 70 basis points, primarily driven by the business mix within integrated processing. As you can see from the pie charts at the bottom left of the page, the meaningful growth of integrated processing volume as a percent of total is driving the overall take rate lower for the company. On the bottom right, we dig a little deeper into our integrated processing volumes and take rates. The meaningful increase in volume for U.S. acquiring and integrated e-commerce continue to impact the overall take rate for integrated processing. Now, let's turn to slide 20 to look at our balance sheet and liquidity. Total debt outstanding was approximately $2.2 billion as of September 30th, and our net debt to LTM adjusted EBITDA ratio was 4.4 times. We expect our pro forma leverage to be approximately 5.7 times by year end, reflecting the additional debt raised and the LTM adjusted EBITDA of the three deals, excluding synergies. We remain focused on delevering and moving towards our target of 3.5 times adjusted EBITDA. Let's move to slide 21 to discuss our guidance for Q4 and the full year. For Q4, we expect revenue of $355 million to $365 million on a reported basis, with minimal impact from the smaller acquisitions we recently closed, Pago Efectivo and Via FinTech. We expect mid to high single-digit growth in integrated processing and a 10 to 15% decline in both eCash and Digital Wallet. For eCash, I'll point out that Q4 of 2020 was an exceptionally strong period driven by COVID-19 restrictions across Europe. So Q4 is a tough comparable period for that segment. For gross profit, we expect to be between $205 million and $215 million and adjusted EBITDA between $90 to $100 million. As a result of our revised outlook for Q4, we expect full year revenue in the range of $1.47 billion to $1.48 billion, reflecting growth from eCash and integrated processing, partially offset by decline from Digital Wallet. We expect adjusted EBITDA in the range of $425 to $435 million. We understand this is a meaningful change from our prior guidance. I'll reiterate why our expectations have changed. In early August, we expected four major drivers that gave us confidence in our full year outlook. First, we expected to pick up momentum in direct marketing, and we are seeing the recovery in our performance in Q3 and October. Second, we expected to continue to drive efficiencies through our cost savings program, which we are exceeding. Third, we expected Digital Wallets to grow double digits, but clearly the current and expected performance is lower than we expected. Finally, we anticipated onboarding meaningful clients in our e-commerce verticals and invested to create the necessary capacity. Expanding further, we had signed agreements in place which supported our confidence in onboarding the clients in early October. We remain excited about working with them, but the scope and timing will differ from our initial agreements, meaning volumes will be more spread out with components going live throughout 2022 instead of the ramp we initially expected in Q4. Now turn to slide 22. While we will provide formal 2022 guidance on our next call, we believe it's important to provide an update on our preliminary expectations for next year, given the meaningful reset of our Q4 and full year 2021 guidance. For 2022, on a reported basis, we expect revenue in the range of $1.53 to $1.58 billion. Integrated processing is expected to grow double digits, and eCash is expected to grow in the mid-teens, including the inorganic contribution of our 3 acquisitions. Digital Wallet is expected to decline in the mid to high teens as we reset the business. Adjusted EBITDA is expected to be in the range of $440 million to $460 million, resulting in flat margins year over year. At our Q4 call, I will be able to provide additional color on volumes, gross profit, and other variables. We will also provide more detail on the quarterly cadence of revenue. At this time, we anticipate Q1 being down year on year or roughly flat sequentially, given our current expectation for the Q4 run rate this year. Overall, there is no sugarcoating that our financial results are disappointing and not up to our expectations. We have a strong plan to get Digital Wallet back to double-digit growth, but we have to go through the necessary transition in 2022. We remain excited about Paysafe's outlook as we continue to deliver on our strategy and see strong growth and execution across the majority of our businesses, which continue to exhibit strong momentum. Now, I'll turn the call back to Philip for closing remarks.
Thanks, Izzy. Although we are revising our financial outlook, we have a strong plan to turn around Digital Wallet and remain very optimistic about our future as a leading specialized payments platform. To put this into perspective, last week I met with my wider global leadership team. We went through our performance and the road ahead. Despite the revised financial outlook, the level of energy and engagement was just at an all-time high. And that's because we see the deals we're winning. We see the pipeline that we're building. We see the combination of our API connectivity, the multiple payment types, and risk management is a real difference maker in the market. While it'll take us longer to accomplish the financial goals that we had planned, the team and I firmly believe that Paysafe's absolutely positioned to be a winner in the marketplace, partnering with leading-edge companies in some incredibly exciting markets. This concludes today's presentation.